Welcome to this episode of Founded in Tech. I'm your host, Mark Eckerly, and today's show is part of our Tech Tips series, where I sat down with Dan Mayo to talk about the current tax law and possible changes under the new administration. On today's episode, we discuss what the possible tax changes will be for individuals, what the outlook is for corporations and the possibility of the looming tax hikes, and we cover certain planning techniques under the estate and gift tax, since there will be some changes to come there as well. Dan is full of knowledge, and it was great picking his brain on this episode on the current state of the election and the impending tax changes to come. I hope you enjoy this episode. Hello, everyone. Welcome to today's show. Dan Mayo is joining me today to talk about possible upcoming changes to the tax system. Hey, Dan, how you doing today?
Great. How you doing, Mark?
Doing well. Doing well. Thanks for joining us.
Pleasure to be here.
So to kick us off, why don't you give us a quick background of yourself, your role here at Withum, and what you do?
Sure. Thanks. So I'm a lawyer by training, and I function at Withum. I spend my time mostly doing federal tax policy, and I focus on the M&A side and also national tax policy, like things like this: election results, outcome, year-end planning. And I spend a lot of time writing articles on new issues that come out, new regulations, et cetera, and regarding new tax items, and advising the firm and clients on federal tax issues.
Awesome. So it's definitely been a busy couple months for you, I'm sure.
Very busy.
So as you alluded to, why don't you kick us off by giving us a quick state of the election, right? A background of the results, a breakdown of what's kind of been going on, and where we currently stand.
Great. So as we know, Joe Biden is now the vice president-elect. Kamala Harris is president-elect. Kamala Harris is the vice president-elect. It's now January 6th, which means we had the runoff election yesterday in Georgia for the 2 Senate seats. After the election, the Democrats also retained control of the House, but with a slimmer majority than they had before. The results, at least as I'm seeing up as the moment of we're taping this, the Democrats appear to have won both seats in the Senate, which means there will be a 50-50 tie in the Senate, and Vice President-elect Harris will have the tie-breaking vote. So it appears that Democrats will have control of the House and the Senate in the new Congress. Which what does that mean? Right. The next question is, what does that mean for federal tax policy? I think that means that we're going to see a very progressive agenda come out of the Democrats, and perhaps one of the most progressive agendas in history. This is the unique combination of Democratic control of the White House, as well as the House and the Senate. And I think we're going to see a lot of reversal of the prior administration's agenda, and a lot of more progressive items, climate change, taxes, et cetera.
So now that they have kind of majority control, right? What does that look like from? And we'll dive into both aspects from an individual and corporate perspective. But starting off from an individual's tax standpoint, what does that look like from the current tax law, and what changes are being proposed? What changes do you think will be passed? What does that look like from an overall structure standpoint?
Yeah, so there is a slim majority, right? It's 50-50 in the Senate. So they will need everyone on board, all the Democrats on board, to pass the agenda. So it's not right. There is still going to be an element of bargaining with bipartisanship and bargaining with the other side, because you need everybody on board to pass the legislation. So having said that, we do expect there to be tax increases. When you look at the proposals that Joe Biden had put forward during the campaign season, there were many proposals that would increase taxes on the individual side. So first off, he would raise the maximum individual tax rate from the current 37% back to 39.6%, which is what it was back in 2017 before the Tax Cuts and Jobs Act. He would also phase out a lot of deductions, itemized deductions. So many of the proposals are aimed at people making either more than $400,000 a year or more than $1 million a year, what he calls the high earners. And so a lot of the proposals are aimed at them. And what he has said throughout the campaign is he will not raise taxes on the middle class. And so, whether that just means no one over 400, probably not the case. I'm sure taxes will go up for people making less than 400. But a lot of the proposals that we've seen are a little bit vague, which we would expect during a campaign, because the more vague the proposal, the harder it is to attack it. So what other things are we saying? Raising the marginal tax rate from 37 to 39.6, a phase out of the qualified business income deduction. And that's the deduction that came in 2017 as part of the Tax Cuts and Jobs Act to equalize the tax treatment between partnerships and S corps on the one hand and C corporations on the other. When the corporate tax rate came down, they wanted to somewhat equalize or try and equalize a bit the treatment between S corps and partnerships and C corporations. So once they gave that lower corporate tax rate, they came out this qualified business income deduction and 20% of qualified business income for partnerships and S corporations. Biden would phase that out for people making more than $400,000 a year. So there would be immediate tax increase for owners of partnerships and S corporations on the individual side. He would also phase out itemized deductions, the benefit of itemized deductions for taxpayers making more than $400,000 a year. The next item I'll mention is very significant, but it hits a smaller class. It's targeted to a smaller class of taxpayer. And so one of the proposals would be to increase the rate of tax on long-term capital gain from the current maximum rate, which is 20%, to 39.6%, which would be his maximum rate on ordinary income. But this would only apply to taxpayers making more than $1 million a year. But this is by far one of the most, people say draconian measures. For many years, there's been a preferential rate for the long-term capital gain, and to essentially eliminate that benefit for long-term capital gain and put it on par with ordinary income is a significant change from a long-standing and existing law. The one final change I'll mention on the individual side, there's certainly many others, but the one I'll mention is that he would increase the rate of Social Security tax, employment taxes, right? So you recall that employment taxes, there's a 6.2% Social Security component and a 1.45 Medicare component. He would right now, as of for 2020, that's on most people's minds, it was 137,700. It went up to I think in 142,000 range for 2021, but that stops. So that 6.2% tax stops at $142,000 approximately in 2021. What Joe Biden has said is for people who make more than $400,000 a year, he would bring that 6.2% back. So all income over 400 would be subject to an additional 6.2% employment tax. So that's a fairly significant tax increase for the high earners. It's not clear what he would do on the range between 142,000 and 400,000, whether there's some intermediate tax would be applied to that, or the full or nothing, or the full 6.2%. It's not clear what he would do on that the gap period, the gap amount between 142 and 400. But we don't believe that he would impose the employment tax in those amounts.
So it looks like a lot of these proposals, tax changes, are on the quote unquote 1%, right? The higher, anyone above 400,000 that are the wealthy individuals. What would be the possible changes to the middle class? What would that look like? You said it would be possible tax raises. How significant do you think that would be?
Well, we don't think it would be very significant because, again, his main agenda and sort of his tagline for when he was running for office was, "I will not raise taxes on the middle class." George Bush famously said that and then went against that promise, the first Bush, that is. And so it's not clear. We do expect some tax increases, right? We've had massive stimulus spending. The latest round was $900 million. For various items, 900 billion. I'm sorry. In late December, they passed a $900 billion stimulus. I think that was a number 6 or 7 in terms of stimulus legislation. And Joe Biden said that's a down payment for the next version. So, given the massive government spending that's taken place in the past year, it's likely there's going to be tax increases beyond what was advocated during the election season. So that we do expect there to be some increase in taxes on the middle class. Certainly, they will be diminished and smaller in comparison to taxes on those making over 400, and definitely those making over $1 million a year.
Mm-hmm. And then now that we are into January 2021, do you expect these tax laws to be approved for fiscal year in 2020, or is this for future years? When do you think this will be enacted?
It's interesting. Congress does have the authority to make the tax laws retroactive. They rarely, if ever, exercise that authority. So what we expect is that if there are tax increases in 2021, it would be retroactive only to January 1st, 2021, and it would not affect the rates going back to 2020. So that any rate increase, if it's passed in 2021, would only be retroactive to the first of the year. If nothing's enacted until 2022, it would be effective most likely the first of 2022.
Okay. So then I guess jumping over to the corporate side of things, would that retroactive rule probably apply as well to January 1st, 2021? So it would be for future years. And then if you could kind of break down the corporate tax proposal compared to the current tax law and what's the likely outcome there?
Yeah, absolutely. So yes, the retroactivity we would expect it to be the same, so that any legislation passed in 2021 would be retroactive to January 1st of this year, and we don't expect it would impact 2020. On the corporate side, again, we expect more tax increases, right? The maximum corporate tax rate was 35% before the 2017 tax legislation. It's now 21%. There's a flat rate of 21% imposed on corporations. Biden has proposed raising that rate to 28%. So, approximately 30% increase in the corporate tax rate. Although that is a large increase on the corporate tax rate, historically it's not a high tax rate, and so not that it's much comfort to corporations paying the tax, but it's not a historically high rate, and it's certainly lower than it was back in early 2017. Other things that Biden has proposed on the corporate side, repealing the like-kind exchange rules, so it would significantly affect the real estate industry. Their ability to defer gain on the sale of real estate as long as they invest in like-kind property. He has proposed repealing those like-kind exchange rules for taxpayers making over $400,000 a year. He also proposed tightening the opportunity zone regime. That's a tremendously impactful regime that encourages investment in struggling communities. And so one of the things he proposed to do was to tighten the regime and possibly limit it to encourage more affordable housing and job creation within the opportunity zones. So we would expect there to be some tightening of the opportunity zone regime, mostly because it's expected to impact the wealthy as opposed to the middle class. The more on the international side, he would raise rates on the GILTI tax, which is the global intangible low tax income. He would double the rate there from 10.5% to 21% for companies that invest abroad. Also would create a new minimum tax of 15% on global book income, but that would only affect larger corporations, companies with at least about $100 million in book income. So there are some proposals to tax the largest corporations in new and novel ways that haven't been done before. There's also proposals just to raise the corporate tax rate, as you said, 21 to 28%. There wasn't significant focus during the election season, but the VAT tax is always something that hangs out there because it's just such a large revenue raiser. So the VAT tax is a value-added tax. It's something we see more frequently in Europe. And it's functions similar to a sales tax, but it taxes sort of every level in the supply chain. And so we always, on the horizon is always a VAT tax, and whether one will come in the U.S. just because it's such a large revenue raiser. And usually they start out with lower rates that build to become more, larger over time. So that's something that hangs out there, but not something focused on particularly by the candidates during the election.
Okay. So just to kind of bring in summary, President Trump was running for president, his whole goal was to lower tax rates, bring jobs back to America. And now it looks like we're kind of shifting the other way, where with President Biden, we're going to increase tax rates. Is that going to force jobs out of America? What's the kind of driver behind this, and why would he increase the corporate tax rate from 21 to 28?
Yeah, so there means a revenue raise, right? The main reason to raise rates is that the government needs the money. It's not like he's trying to penalize corporations or anything. This is still America, and we're a capitalist country. But I think those proposals that you hear from Donald Trump, I think many of them are similar, just with a different bent from Joe Biden. And so what he said is a lot of times he's proposing to like a Made in America tax credit, something which would give a tax credit to offset some foreign taxes if it's made in America, and for products sent abroad. Also, he creates an offshoring tax penalty, right? So he wants to prevent the movement of jobs offshore. So he would create a penalty, a surtax on profits of 10% for companies that send jobs abroad. So there are, Biden is not just about raising taxes, at least what he stated on the campaign trail is that there are proposals in effect to bring jobs back to America and encourage exporting, encourage bringing jobs back to America and manufacturing here in the United States. So there are a raft of tax credits that he's proposed for the manufacturing sector to help shore that up and increase the manufacturing within the United States.
Okay. And as you mentioned earlier, so we're on our second round of stimulus, and this is possibly the beginning of more. With Biden's current tax structure or plans that he outlined during his campaign, do you think that it could increase beyond that if there's further stimulus packages that are delivered to kind of offset that? Do you think that's a possibility at all?
Yeah, I think there's likely going to be a significant stimulus legislation in the new year. And as I said, Biden mentioned that the December stimulus of 900 billion was a down payment. He viewed that as a down payment on what's to come. So I think we're going to see, massive government spending continue in the short run. The Fed has indicated they're not even thinking about raising rates. So we're likely to have a low interest rate environment for years to come. We're likely to see, significant government spending increase, which would also involve tax increases, right? They have to fund the spending somewhere, and so the tax increases, I think we're probably going to come under in either administration. Although one is more vocal about saying we're advocating for it, but eventually, given the amount of government spending, either you reduce spending or you raise taxes. There's no magic to funding the government.
That's what I figured. That's why I assumed if there was more stimulus packages to come, that they would just have to raise taxes further beyond what they're saying it is now. That's, it's a give and take.
Right. We're as working at an accounting firm, we know there's certain truisms about finance, and one of them is when you're funding a government, you either have to raise money or raise revenue or cut expenses. There's no magic to this, and there is complication about where you do that and where you raise the funds and who shoulders the burden, and also where you make cuts and who shoulders the burden of any funding cuts. But fundamentally, those are the two options.
Gotcha. Okay. Awesome. So quickly transitioning over to estate and gift tax. What would be the changes there? I know that's kind of been a hot topic for a lot of people that I guess maybe are on the wealthier side, where they're kind of transitioning money or move it between their sons or daughters. So what would that look like on Biden's current proposal compared to the current tax plan? What's the likely outcome there? Is it just higher tax rates, or what would be the kind of nuances there?
Yeah, so there was a lot of talk about this particularly over year end, a lot of planning on the thought of, that if there's changes in the rules in 2021, it would not involve a clawback to 2020. So we saw significant year end tax planning by wealthier individuals who wanted to use up their lifetime exemption. So the way it works now, there's about $11.5 million lifetime exemption for every individual. It doubles for married couples. You have just over 23 million for a married couple. And that lifetime exemption, gift and estate tax exemption, is scheduled to drop to $5 million in 2026. Right, that was a temporary amount, so it was scheduled to drop anyway. Biden has proposed reducing that sooner, so it's not clear though whether he would reduce it to pre-2018 levels or to 2009 levels. So either 5 million or 3.5 million would be the exemption under, if Biden is able to pass that. So that the major proposal is reducing the lifetime exemption, which is why we saw significant activity at year end. The other major thing he would do is eliminate the step up in basis upon death. So right now, if an individual passes away with appreciated securities, the beneficiaries receive a step up in basis, which eliminates any tax on that built-in gain. And so one of the things that Biden proposed is eliminating that step up in basis on death. And what's not clear is when he would impose the tax. Would it be through basis adjustments to the beneficiary, or would it be through requiring the tax be paid at the moment, with the final state tax return? So it's not clear when the tax would be due, but he has proposed eliminating that. Again, that's a fundamental change in estate tax, and certainly would have a significant impact on the wealthier individuals.
So you mentioned Biden is proposing dropping that lifetime exemption sooner. Would that be in the current year, you think, or would that be or in future years where also at the end of 2021 we could see a lot of estate planning as well for wealthy individuals?
Yeah, if it's passed, if that the proposal is enacted, it would likely be this year, and they would probably bring it back either to 5 or 3.5 million, effective January 1, 2021. But again, the legislative process produces a lot of strange results, and what comes out of the legislative process is not necessarily what the politicians put into it. And so, there's heavy negotiation on these provisions, and even within the Democratic Party. So it's not as if the candidate has the ability to enact his proposals carte blanche. He doesn't have carte blanche to enact his proposals on a wholesale basis. There is a significant negotiation in Congress, and so that even if he proposes reducing it to 5 or 3.5, that's not necessarily what would happen.
Mm-hmm.
So you can predict at best you can predict directionality of taxes and particular tax items, but exact amounts are hard to pin down.
Gotcha. Awesome. Yeah. So I guess really quickly in summary, I mean, we covered a bunch of great topics here. What advice would you give or would you recommend to individuals or companies when planning for and anticipating these possible upcoming changes between things being likely to be adopted for 2021 or possibly in future years? Can companies be proactive in planning for these tax impact changes, or what would that look like, and what advice would you recommend?
Yeah, so I think the advice we typically give clients is to consider your future plans, and don't let the tax tail wag the planning dog, as we say in the tax world. Taxes are an important part of your business, but they shouldn't be driving the business decisions. And so if you have a business plans, taxes may accelerate them, may cause you to shift direction slightly, but fundamentally, you operate your business the way you would operate it. And we can model out the taxes for you. We can help model them out, which may cause you to accelerate some decisions and defer others. But we don't recommend drastic action based upon a candidate's proposals, again, which may or may not be enacted into law. And then even if enacted, they may come up in different form than they were proposed. So
Mm-hmm.
the best advice we give clients is stick with your business plans. And we can help you model the effects of what the tax rates would do, either on the individual side or the corporate side. But that the tax laws should cause you changes to the tax laws, while significant, are probably not going to drive the business decision. So that the exigencies of business should control, and the taxes will be a component that you factor in, as they say, causing to accelerate or defer certain activities.
Yeah, and it's never too early to consult your tax advisor, especially as we're rolling into tax season here. So especially be proactive with that thinking, and make sure you're well ahead of the game.
That's right. Yeah, planning takes time, and to make some decisions, it definitely takes it can take weeks or months or even longer in some cases. And many people bumped up against that at year end when they were unable to get plans done because they started too late in the process. So we understand that estate planning lawyers were turning away work because they just had too much going on. So these things do take time. A lot of times you need valuations, particularly with estate planning. So those kinds of things take time. And so we do recommend, speaking to your advisor sooner rather than later, to develop a plan and put in place so you have contingency plans if these tax increases are enacted. How will it impact you, and how can you pivot in response to the changes in tax law?
Awesome. I think you hit the nail on the head there. Well, that wraps up today's episode on the current tax climate and the possible changes to come. Thank you, Dan, for joining me today. If you'd like to learn more, please visit witham.com, where you can find Dan has authored numerous articles and other content. So please visit the website if you want to hear more. Thank you.
Thanks, Mark.
Thank you for tuning in. If you liked it and want to hear more, you can follow us and subscribe, and we'll see you next time on Founded in Tech.